We're going to take a wide view of what's driving M&A in 2010. Then we'll tighten the focus to what is driving interactive deals, and it's one word, data. And then we'll zoom in on 5 specific predictions for 2010. We have a tight flight plan for this morning, so there's no time for humor. This is all going to be very, very serious. All right. So first, M&A market update. Rebound in deal value through the third quarter in terms of volume of deals, but the value of deals is not yet back to 2005 levels. Large cap M&A is largely quiet, but a ton of smaller exploratory deals as companies look to add new capabilities, new technologies, new teams, and new customers. So the graphic on the right says it feels like we're climbing up, but we're still underwater in M&A terms. There are 4 major drivers that are driving M&A very broadly today, looking across the media, information, data, and technology businesses. Very high levels of liquidity in the market. There is a lot of cash in both corporate and PE, private equity coffers sitting on the sidelines. Second, traditional media is innovating for growth. Third, technology companies, very interestingly, are entering marketing services in a big way. And finally, fourth, massive innovation in the ecosystem from emerging companies is shaping the media and information business as we know it. Jumping into the first one, unprecedented levels of cash on corporate balance sheets, well over $1 trillion in liquid assets on the top 1,500 companies. Dramatic increase over the last 2 years as they all hoarded cash during the downturn. And they're all looking forward and seeing relatively poor macroeconomic growth, over-leveraged consumers and slower industrial output over the next couple of years. They know they need to deliver growth. They're going to do that to a large extent through acquisitions. Second, private equity firms have more than $400 billion of capital in what we call the overhang, money that was raised largely over the last 5 years that has about another 5 years in which it needs to be invested or it gets returned to the investors. And that $400 billion will be put to work for the most part. The missing piece, though, right now in the market is still debt. Private equity works when there is debt that can put up anywhere from 30 to 60% of the money for the deal. Otherwise, private equity can't really get the returns they're looking for. And right now, it's still very difficult. The cartoon on the right says, well, how about 3 times trailing 12 EBITDA? Okay, would you consider 2? That's very much what the market feels like, although debt is improving. Second, traditional media companies transforming their businesses, tapping into high growth new models and mitigating some of the damage that the friends we've heard from today are inflicting on their traditional businesses. Hearst iCrossing is a great deal. Randy was kind enough to note that we played a role in that. CFO sold The Economist and brought Congressional Quarterly. What a coincidence, those were our deals too. And then Disney buying Playdom, we had absolutely nothing to do with, but another great example of traditional media companies playing for growth in these markets. Technology companies are investing in a big way in data, analytics, optimization, and advertising solutions. From their point of view, advertising is one big data processing and optimization problem. IBM has made a string of acquisitions. They're actually speaking at a conference we co-sponsor in Florida later this week. You all are welcome to drop by. And companies like Akamai, Cisco, Adobe, and Accenture are also investing aggressively, going into marketing services, competing with the likes of Omnicom and WPP. Finally, emerging media companies in digital marketing services and mobile are driving M&A. They accounted for 74% of the deals in year-to-date 2010 compared to all the other sectors of media, data, marketing, and related technology. However, deal value is only about $33 million on average compared to $100 million for those other sectors. So an avalanche of small, I mean, $33 million isn't small. It's more money than I have in my pocket now or actually at any time in the history of the universe. But it's, in the M&A world, relatively small deals, but a high volume of those. Okay, let's zero in on interactive, what's driving M&A, and clearly it's data everywhere, but not a thought to think. The market is shifting to selling audience-specific sites. Everyone knows this fairly well by now. Traditionally, and I was once CEO of a decent-sized online publisher, we sold site-specific, or we sold vertical slices of our sites, or we'd offload inventory to an ad network that would aggregate into channels around specific sites. Now the big push is selling through audiences, individually targeting folks based on behavior. Are they in market? What are they looking at? What's their demographics? And if you look at the growth, total display is expected to grow from about $7.5 billion last year to $9.6 billion next year. We estimate that audience-based selling was about 20% of the market last year. And just fun with numbers, assuming it grows to 30% by 2011, that means that audience-based selling is growing at 38%, site-based selling is relatively flat at 5%. That's where the growth is, and most media companies are thinking hard about how they participate there. With the result that a fairly crowded value chain is squeezing margins for display. And this is for audience-sold media. Site-sold media goes for different CPMs and is sold in different ways. But for audience-sold media, say an advertiser is willing to pay $5 to reach somebody with a specific in-market intent. The agency takes 75 cents of that. The ad network, typically at a 40% gross margin, is at $2 of that. The data provider, 75 cents. The ad exchange at 25 cents. Ad serving and rich media all in, call it 25 cents, with the result that there's a buck left for the publisher. And a bunch of folks, when we first presented this, came to me and said, that can't be right. Publishers aren't getting screwed that badly. Well, they're not getting screwed. They're willing to sell this inventory for $1, and the folks in the middle are able to mark it up and sell it for $5. So you have new participants like the data provider and the ad exchange putting new pressure on the agencies, the ad networks, and the publishers. And new players are piling in all the time. Since we did this chart, we could add another 3 or 4 sort of stations along the buffet line here of people loading up their plates. Well, that's very interesting. Well, let me go back. All right, so most data originates with publishers. All this user data comes from publishers who then share it either knowingly or less knowingly with third-party aggregators, but it all originates with publishers. So the big question is, how do publishers get paid for this data? And one side question, cookie deletion runs at least 10% a month. ComScore believes it's as high as 40%. So that data has to be constantly refreshed. Is that the publisher's friend? We think there's a real strong economic model there. However, publishers need help sorting through their data. We asked one major participant in the data market just to show us the volume range of data that they're seeing sold by CPM and then how it stacks up by value. So starting from 50 cents all the way up to $11, you can see a very broad range of the CPMs in terms of volume for data sales. And then to the right, not surprisingly, the revenue skews toward the top. So the top 7% of data across a broad range of publishers is pulling in 20% of the revenue. The top third is pulling in half the revenue. And the bottom half of the data is only about a third of the revenue. So clearly, there's a lot of value to be lost here if it's not managed properly. And we think there's a big opportunity that a number of folks are jumping on to help publishers manage that. In an oversimplified view for publishers, there's only 2 options with data. Either no data sharing period, the hell no we won't go, or the I'm not that kind of girl speech, or you share data freely. You sell it to everybody and you frankly commoditize your own media. We think that's a false dichotomy. It's not really binary. There are a broad range of options that publishers have and that are increasingly getting developed and proven for leveraging and monetizing and managing the value of their data. All the way from buying data append for their own audience, kind of a no-brainer, not as much value there, much more value in building affinity ad networks and in creating private data co-ops with key customers. And finally, reaching your own audience across the cloud to increase frequency against your most valuable audience. And finally, for the sites who choose to do this, and not all will, selling data but with stringent rights management. One major data participant told us that if he was a publisher, he'd get into the data business with reputable vendors and ironclad privacy policies. And we wonder if this could be 15% incremental revenue, which for a publisher, which is a fixed cost business, is meaningful, but it requires very different skills and business processes. This value chain will consolidate. We believe it'll consolidate not just in behemoth offerings like Google and Microsoft, but with mid-sized intermediaries, and particularly with new players entering the market, like some of the technology companies we've seen entering marketing services. As they consolidate that value chain, they'll rationalize it. Margins will improve for both advertisers and for publishers in this audience-based display value chain.